So we are going to pick up with chapter 11 today. So in chapters 9 and 10, really 10 I should say, is we first started out by talking about the different means by which taxpayers acquire assets. Okay, we don't always purchase our assets. There's different ways we may obtain them. And the method by which we obtain the asset is important because that determines the basis that we use for purposes of cost recovery. So first we learned which is the right basis to choose based on how we acquire asset, and then we learned how to recover the costs related to the asset. Okay, now our focus is on the disposition of these assets. We're now either going to sell them or dispose of them by some other means, and we're focusing on how to calculate and then record the gain or loss associated with the disposition. And as we will learn throughout this chapter, and as hopefully you've obtained from your reading, guys, is that the manner of disposition affects how we are going to treat these gains or losses. Okay, different dispositions have different tax treatments. We are going to look at some more than likely non-taxable treatments on Thursday. For today, we're really going to be focusing on we're selling assets, therefore we're really going to be recognizing these gains or losses, but how are we going to recognize these gains or losses? Guys, this all starts, we're going back to Code Section 1001. You've heard me mention this when we talked about Chapter 5 and Chapter 7, okay? Anytime you sell or otherwise dispose of an asset, it calls up Code Section 1001, okay? And this is really a realization event, so we're talking about realization again, okay? We have two taxpayers, they engage in a transaction, and as a result of the transaction, property rights are different after as opposed to before the transaction. I now own something that I didn't. I maybe now have cash, someone else now has my property, vice versa, okay? And then also we always have to remember that, okay, generally when we have realization, we have recognition, which means we're going to report the gain or loss. But we don't always have recognition, okay? Again, if we have an exclusion or a deferral, we don't have to recognize, and recognize, guys, simply means, am I putting it on my tax return, or am I not going to put it on my tax return, okay? Recognition is just simply, is it or is it not going to be reported on the tax return? And again, in the next class, we're going to be focusing on different scenarios where more than likely we're not going to be reporting the gains realized, okay? So, guys, we're going back to this, what seems like a simple sentence. It starts with Code Section 1001. Our amount realized, okay, is anything we receive in the exchange minus our adjusted basis of the asset that we're about to dispose of, that we're giving up, okay, equals our realized gain or loss, okay? That's our realized gain or loss, guys. I put recognize is a question mark. Yes, generally we are recognizing, but there are provisions where we're either going to exclude the gain altogether or we're just going to defer it for some period of time, okay? Going back, breaking it down. Amount realized, guys, is our sales price, okay? Anything we receive, cash, but okay, we don't always just get cash. We may get paid in trade, okay? We may receive services, the fair market value of those services, the fair market value of property, okay? I may accept stocks instead of cash. What's the fair market value when I receive them? Someone may pay off my debt, okay? That is gain to me. So these are part of my sales price. Minus any selling expenses. Did I have to pay an attorney to transact this exchange? Do I have to pay a broker, his portion of the fee related to the sale and exchange? That comes off of my sales price, okay? So that is my amount realized. Then I go to my adjusted basis, and this is what we spent the whole last chapter looking at. First, it's my original basis, and this starts with how did I acquire my asset, okay? We said if you purchase it, it's the cost of the asset, and then there was different things included in the cost, okay? We talked about those. If it's a gift, the general rule says that I use the carryover basis. What did the donor pay for the asset? If I inherit it, okay, at the time they die under their will, then it's the fair market value at the time of death. Personal to business conversions, the rule says that it's the lesser of the cost or the fair market value at the time of conversion. And then we spoke about some qualifying non-taxable transactions, which we'll talk about again more on Thursday. And the general rule there is that you use the carryover basis, okay? These were the basis that we use for depreciation purposes. These apply for when you're selecting an asset, when you acquire an asset and you're depreciating it. these are the basis that you depreciate, okay? The original basis, guys, might be improved, okay? We said you make some improvements, so therefore over time the basis of your asset might actually increase. If you do something to extend the life, significantly improve the value, or change the purpose of the asset, okay? That's an improvement, it's gonna get tacked on. And then really what we spend a large part of the chapter is minus any accumulated cost recovery, okay? For the most part, our depreciation, our amortization, our depletion, which again, we're not looking at, okay? So that's our adjusted basis. So as time goes on, guys, first we acquire the asset, we may improve it, and then we're gonna depreciate it. So your basis of your asset is changing all of the time, and we need to keep track of that, and that becomes important now when we're going to sell this asset, okay? So the difference between the amount realized, adjusted basis, guys, is our realized gain or loss. And this is really what we're focusing on now. Good? Sort of a simple review. Okay, guys, so looking at these basis rules, these are the rules we looked at for purposes of depreciation, okay? We said if you acquired an asset through one of these means, this is the basis you select for purposes of depreciation. But I am now, there's two things highlighted here in red little asterisks, okay? When we go to sell our assets, we reduce it for the adjusted basis, the sale, okay? There's two assets here where the rules may change, okay, for purposes of selling the asset. Meaning, we may not necessarily use carryover, or we may not necessarily use the lower of the cost or fair market value. I can't speak. When it comes to gifts, guys, for purposes of calculating gain or loss, when we dispose of this gift, okay, we might have taken this gift, we might have used it in our business for a while, and now we're selling it, we no longer need it, okay? The rules here basically say, look, if the fair market value of the gift at the time that we receive it is less than the donor's basis, okay? It's basically a depreciated piece of property. Then when we go to sell it, we need to know the sales price in order to figure out what basis we are using, okay? So for depreciation purposes, guys, we are gonna always use the carryover value, because when we're starting to depreciate something, when we're putting it in our books, we obviously don't know what we're gonna sell it for in 2, 3, 5, 10, 20 years, okay? So for depreciation purposes, you are using this carryover value. But when you go to sell it, and you have to reduce your amount realized by the basis, you are not necessarily defaulting to the carryover rule, okay? The rule says this: when it comes to gifts, and now we're disposing of this gift that we've used in our business, the rule says that if the fair market value at the time of the gift is greater than its carryover value, okay, meaning it's an appreciated piece of property while the donor held it, then we're going to stick with our carryover rule. So when we go to sell it, we're going to subtract off the carryover value. If, however, it's a depreciated property, when it was gifted to us, okay, the fair market value is less than the donor, what they paid for it, their basis, then the dual basis rules are in effect. This is what's called the dual basis rules, okay? And this means that we don't know what our basis is until we know the amount we're selling it for. We need to know the sales price in order to know what basis we are subtracting for purposes of calculating the gain or the loss. I would recommend to you doing this somewhat visually, okay? This is just a made-up example. I'm now selling an asset that I received as a gift, okay? It's an asset I received as a gift. I used it in my business, and now I'm getting rid of it. And at the time I received it, the fair market value was less than the carryover basis. That's the scenario we're worried about. That's when the dual basis rules come into effect, when I was gifted a depreciated piece of property. I'm now selling it. And I've got a couple of different scenarios here, okay? At the time I received it, the donor had a basis in it of 6. Sorry, I know not all of you can see this, and I can't tip this over, can I? When I received it, the donor had a basis of 6, okay? And it had a fair market value of 4, so it's depreciated by 2. And now I've got a couple of different scenarios. In my first scenario, I'm gonna sell it for 8, okay? Well, the sales price is higher than either of these numbers. So pick the higher of the two figures, okay? 8 minus 6. And then for my realized gain would be 2. Let's go to the other extreme. Let's say I can only sell it for 2. Well, that's then lower than either of my two options. So use the lower of the two numbers, okay? So my sales price is 2. Pick the lower of the two numbers. It's 4. Difference, I have a 2 loss. If my sales price is somewhere in between my two options, then you adapt the sales price as your basis, and you will net 0, okay? So if your sales price is higher than both figures, pick the higher of the two numbers. If your sales price is lower than the two figures, pick the lower. If your sales price is right in the middle, then the sales price also becomes your basis, and you have a net gain or loss of 0, okay? And again, guys, this only applies if at the time you receive the gift, the fair market value is less than the carryover basis. If at the time of gift, the fair market value is higher than that carryover basis, it's an appreciated piece of property, then we stick with the same rules we use for depreciation. We just use the donor's basis, the carryover basis, for purpose of calculating our gain or loss. Okay? This is the dual basis rules.
It's not up there.
Personal to business conversion. We're going to do that one next. Are we good, guys? Like I said, I just recommend, like, it's hard to remember all this stuff written, and so do it visually. Just, you know, you've got two choices for your basis. It's either going to be the carryover, the donor's carryover, which is what we use for depreciation purposes, or potentially the fair market value. So again, look and see, is my sales price higher than both numbers? Is it lower than both numbers? Or is it somewhere in the middle? And work that way. Now I also, look, I'm just going to point out, that's just for gifts, guys, okay? When it comes to inheritance, the rules stay the same that they are for depreciation. So for depreciation and for purposes of sales, your basis is always going to remain fair market value at the time of death, okay? There's no change to the inheritance rules. We're always, always, always using fair market value at the time of death. When we have a personal to business conversion, okay? We have an asset we use personally, we start out maybe a sole proprietorship. For depreciation purposes, we said you're going to depreciate the lower of what it cost the person when they bought the asset, or the fair market value at the time they converted it from personal to business use. That's the rule for depreciation, okay? But when it comes to calculating a gain or loss on the disposition of this asset that was originally used personally and then converted to business use, it's similar rules to the gift rules. We have to look to see, was the fair market value at the time of conversion lower than the cost basis? If we were, okay, or if they were, I should say, then again, we're on the same dual basis rules, okay? So for these two assets, when you're going to sell them, always look to see, is the fair market value less than the carryover basis at the time of the gift or at the time of the conversion? The fair market value is lower, the dual basis rules are in effect, and we have this sort of situation where you have to figure out what is the appropriate basis to subtract when I do my calculations for purposes of the gain or loss. There's a problem number 38, which we can go through for the personal to business. Page 41 if you have the book. We have Franco. He converted a building from personal to business use in May 2013 when the fair market value was 55. He purchased the building in July 2010 for 80. And then in December 15 of this year, he sells the building for 40. On the date of the sale, the accumulated depreciation he had taken so far was $5,565, and they want to know what is his gain or loss. Okay? So we have this asset. It was a personal to business converted asset. Okay? When he originally purchased the asset personally in July 2010, cost him, I should say, $80,000. Okay, so that's his cost. And then he converted it in May 13 to business use. At the time, the fair market value was $55,000. Okay, right away you should be saying to yourself, the fair market value at the time of this conversion is less than what his cost was. Okay, so I have a problem. It's a depreciated piece of property when he contributes it to the business. So now these special rules are going to be in effect. Okay, so that's the first thing you're looking for. Is the fair market value higher or is it lower? Depreciated property, you have to change the rules. Okay, the rules say take the cost and take the fair market value, subtract the accumulated depreciation from both numbers, and then come up with a new base for each. Okay, so now you have a new basis for cost, and then you have a new basis for where the fair market value is. Okay, and again, they gave us this $5,565 for accumulated depreciation purposes. So come up with new numbers. Problem goes on to tell us that he sold it in 2015 for $40,000. Guys, again, do it visually if it helps, okay? $40,000 sale price is lower than both my cost and my fair market value. Since it's lower than both, pick the lower of the two numbers, okay? So your sales price minus your new basis after the depreciation, okay, means he has a loss in this case of $9,435. Okay, again, the key with these two problems, guys, is that you don't know what basis you're going to subtract until you know your sales price. It's totally dependent on the sales price. So you can't calculate this until you have that figure in place. Again, for depreciation, stick with the rules we learned last time. But for these two types of assets, okay, when you're disposing of them, you need the sales price in order to figure out what your basis is going to be. Good? Let me ask this one. This is problem number 38. I'm just talking these on. What if I told you here the sales price was $55,000? Can you guys not see that? I wish I knew this trick sooner. What if I told you guys the sales price here was $55,000? What would my gain be? Zero, okay? Because my sales price, guys, would be right in the middle of my two potential options of a basis. So if my sales price was $55,000, you adapt the sales price as the basis, you recognize zero. What if I told you that the sales price was $75,000? Yes, okay? If my sales price was $75,000, it's bigger than both numbers, okay? So you pick the bigger number to subtract as your base. 75,000 minus the 74,435 would be $565 would be their realized gain. Okay? This is the dual basis rules, guys. Again, it only applies to gifts and it only applies to the personal to business conversions when they're receiving a depreciated piece of property. If they're receiving an appreciated piece of property, then stick with the regular rules. Use the carryover basis, or you would use the lesser of the cost or fair market value, generally the cost at that time, okay? Okay, guys. Character, okay? Look, guys, we know in tax by now from Chapter 5 and Chapter 7 when we went through capital gains, it's not enough in tax to just calculate the number, okay, the amount of the gain or loss. We have to understand the character of the asset we're disposing of because assets with different characters have different tax treatments, okay? We talked about this a lot in Chapter 5 and Chapter 7. We have some properties which are tax exempt. We will never have to recognize tax on them even though we may economically be wealthier. We have deferral provisions, which we're going to look at 3 of them on Thursday, okay? Most of our income is going to be ordinary income, meaning it's just going to be taxed using our ordinary rate schedule, not special. Okay, then we also have qualified dividends, which may get special rates, and then we spent a lot of time looking at capital gains and capital losses. Okay, when it comes to capital gains, capital losses, guys, it's important to remember, right? First, we have to understand: are they short-term or are they long-term? Short-term gains get taxed as ordinary income, right? Long-term gains get the beneficial rates, the 0, the 15, the 20%. When it comes to losses, okay, for individuals, they can offset the capital gains, and then we may be able to use $3,000 more. Whatever we can't use after that, right, we can carry forward for an indefinite amount of time. Now, these rules are going to change in a minute when it comes to businesses, but keep that in mind. For individuals, those rules apply, because when we're dealing with sole proprietors, those rules apply to our sole proprietor. Okay. The character, guys, comes from Code Section 1221. You've heard me beat this up a few times, again, when we did income in Chapter 5 and 7. Okay? What does Code Section 1221 say? It says all assets, okay? All assets are capital assets, everything, except for 3 things that we're concerned with, okay? Inventory is never a capital asset. Accounts receivable are never capital assets. And the third category, which really becomes important right now, guys, are our depreciable personal property and real property used in a trade or business. This third category is really our focus right now, okay? They are not capital assets. 1221 kicks them out of capital asset category, okay? Inventory, accounts receivable, depreciable personal property, or real property used in a trade or business. Pay attention to the third one there. Okay, guys? Now, when it comes to individuals, most of what they own is going to be a capital asset. You've been down that road, okay? Most of what individuals own and use are going to be capital assets. But when it comes to businesses, guys, the vast majority of what they own will not be capital assets. Think about what we just kicked out, right? 1221 just kicked out a capital asset contention, most of what is held by businesses. Okay, it just kicked out their AR, it just kicked out all their inventory, and it just kicked out all of their depreciable personal property and all of their real property holdings. So the only thing that may, I mean, there's other exceptions out there, but for our purposes, guys, the only thing that really may qualify as a capital asset in a business setting, some true investments, okay? So maybe they have some working capital, money they keep around just to pay the bills, and maybe they do some, light investing just to kind of keep that money handy and make a little money while they got it there. Okay, so if they have like investments, that may qualify as capital assets, but apart from that, almost everything held by a business, guys, is not going to be a capital asset. Where is this taking us, okay? If you sell inventory, guys, it's going to have a character of ordinary income. If you sell accounts receivable, it's going to get an ordinary character. It's going to be taxed at ordinary rates, okay? When it comes to that third category, our depreciable personal property, our real property used in a trade or business, be careful now, okay? If these items are sold and they have not been hung on to for more than a year, they will get an ordinary character, okay? So if I sell depreciable personal property that I held for 1 year or less, it's going to be considered ordinary. But if I hang on to any of those assets for more than a year, okay, and then dispose of them, guys, they get assumed by Code Section 1231. They become what are known as 1231 assets, okay? So any depreciable personal property, real property used by a trade or business, held on to for more than 1 year, become what are known as 1231 assets, okay? And I will tell you that 1231 is really a temporary status. Nothing at the end of the day is going to be labeled 1231 on your tax return. It's sort of this temporary holding situation where we now need to take extra steps to figure out how these items are going to be taxed. Ultimately, everything is going to be taxed as capital or ordinary. The rules of 1231 and the rules of recapture are going to get us there. Okay, so 1231 is this initial status, but I'm going to tell you it's a holding status. Okay. Now we don't know, guys, how this stuff is going to be taxed until the end of the year. We have to accumulate all of our transactions for the year, especially all of our 1231 transactions. We have to apply the recapture rules. Okay, after we apply recapture, we're going to be left with some 1231 balances. And we have to look to see are the gains, the 1231 gains, bigger than our losses? If the gains exceed the losses, then everything will be treated as capital, okay? All the positive results will be treated as capital gains. Any sales that result in losses will be treated as capital losses. But overall, we will have a net capital gain, okay? If we have a series of 1231 transactions and the 1231 losses are bigger than the 1231 gains, everything will be treated as ordinary. They will be taxed using ordinary labels.
You said that if it's a loss, it's treated as a capital loss?
If you take, so you might have sold 5 assets that had this 1231 flag. And the idea is that you take all 5 sales, some may be positive, some may be negative. You net them together. If it's an overall net capital gain, then all of the sales are treated as capital gains or capital losses. If the overall result is a net loss, then everything will be treated as ordinary income and ordinary losses. Okay, line item by line item. But at the end of the day, you're going to end up with a net capital gain or an overall ordinary loss. Okay? If it's a net capital gain, then individually each line item will be treated as a capital asset, capital gain or a capital loss. Okay, guys. So the idea is, look, 1231. Initially, these items are kicked out of capital asset status. They're kicked out of Code Section 1221. But 1231 comes and assumes this group of assets held for more than a year. And potentially, even though we're initially kicked out of 1221, we could still possibly get capital asset treatment. But we don't know until the end of the year, until we accumulate all of these transactions and go through this sort of netting process, which is what we're going to do right now. Okay, guys. Now, 1231 is said to be a very taxpayer-friendly provision because it's giving us the best of both, okay? We're going to either end up, like I said, with an overall net capital gain, or we're going to end up with an overall net ordinary loss. Now, if we want gains, guys, as a business, we would prefer capital gains as opposed to ordinary gains, okay? Now, for businesses, they don't get the special beneficial rate treatment when it comes to capital gains. They don't get that 0, 15, or 20% rates. They get their tax the same as ordinary income. But we still like them because capital gains are the only means by which businesses can get rid of their capital losses. So a business may generate capital losses, but without capital gains, they have nothing to offset them against, okay? When it comes to capital losses, businesses don't get that extra $3,000, okay? When you're an individual, the rules say you can take your capital losses, you can offset them against any capital gains, and then you can use an extra $3,000. And you can carry them forward indefinitely until you use all of these capital losses. But in the business setting, the most you can do with the capital losses is offset them against capital gains. So if we have no capital gains, we only have ordinary income, we have no means of using these capital losses, okay? When it comes to businesses also, I will say that unlike individuals who can use $3,000 and then carry it forward, businesses can take the capital losses. They can carry them back for 3 years. So if they had capital gains in any of the 3 prior years, they can offset them by amending their returns. If there's no capital gains there or not enough, they can then take them and carry them forward for 5 years, okay? But if during this 3-year look back and 5-year carry forward, there are no capital gains, guys, and they have these losses that they're sitting on, they just expire and go away, okay? And they'll never get the benefit of those losses, which is why capital gain treatment for businesses, even though they're not getting a beneficial rate, capital gains are good because they're the only means of using up these losses. Without capital gains, these losses eventually will just expire and the company will not get the benefit from them, okay? On the flip side, I said instead of ending up with a net capital gain, you may end up with an overall ordinary loss. Look, we just said why capital losses are kind of bad because we're very restricted in their use, right? So if we want a loss, we want an ordinary loss because ordinary loss can offset any form of income. So if we have to have our choice between 2 losses, we want the ordinary loss and we want the capital gain as opposed to the ordinary income. which is why 1231 is a taxpayer-friendly provision, okay? Because it's gonna give us a net capital gain or an ordinary loss, the best of both worlds, okay? It's the preferred form of income for gains. It's the preferred form of loss as losses go. Good? We'll work through a few problems, you'll get it more. Don't laugh, Willis. Okay, guys. So the idea is you're gonna sell these assets, okay? You have these business assets, you may sell them, okay? And you're gonna come up with various 1231 gains, various 1231 losses, depending on how you held these assets, okay? After we do this, guys, and you come up with this initial 1231 loss, you have to now consider what are called the recapture rules, okay? And the recapture rules are just going to basically take some of this 1231 gain or loss and instantly convert it into ordinary income, okay? Because up till now, we're still in contention for capital gains treatment. But if recapture applies, we're instantly right off the bat saying, nope, any of that 1231 gain is now out of contention for capital gain treatment, and instantly we're just gonna flag it as ordinary income, okay? When it comes to recapture, guys, look, it only applies when you take in depreciation on an asset, okay? And it only applies when you calculate a gain on the disposition. Now, the idea behind recapture is this. Look, guys, Congress wants to give us capital gains treatment. It's a beneficial treatment. We just went through the reasons why. If you're an individual, you get special rate treatment. If you're a business, you still like capital gains because it's your only means of getting rid of your capital losses. So Congress wants to give us this. But they only want to give us this sort of special treatment, guys, when we have true economic appreciation related to these assets. But now think about it. When we go to sell our assets, these things we've used in our trade or businesses, most of the reason we recognize gains, guys, is because we've taken depreciation, right? Usually if we're going to recognize a gain, a lot of that gain is due to the fact that we have taken depreciation. Depreciation has reduced the adjusted basis of the asset over time. Therefore, it's increasing our chances of recognizing gain. Well, depreciation, guys, is really just a paper deduction, okay? It's not related to true economics of valuing increasing or value decreasing. It's just a paper deduction granted to us by Congress. So they're not going to give us this beneficial rate treatment when our gains are really being derived from depreciation. So what they're doing is basically they introduce these recapture rules which say, look, to the extent your gain is from depreciation you've taken, we're going to take away the chance of you getting 1231 capital gains treatment, and we're going to instantly mark it as ordinary income. And it makes more sense when you think about it, because when they give you depreciation deductions, what are you taking them against? They're ordinary deductions being taken against ordinary income. So they're not going to give you capital gains sales treatment for deductions that were taken against ordinary income. So that's the reason behind recapture. So again, guys, look, recapture applies only when you calculate a gain, okay? It never applies. If you calculate a 1231 loss, no recapture is going to apply. Keep moving, okay? But if you have a gain, you have to consider recapture. If you take in depreciation, you have to consider recapture. Other note, just keep in mind, guys, the recapture rules do not change the amount of the gain or loss you calculated, okay? It's simply a mechanism to change the character of the gain. You're not changing amounts, you're just changing character.
The textbook, it was talking about land that qualifies as variable property. Are we going to consider with that?
Land is absolutely, well, think about it. Do you take depreciation on land? No. So land is a 1231 asset because the third category we said is real property used in a trade or business held for more than 1 year would be a 1231 asset, but you don't take depreciation on it. So it will be a 1231 gain or loss if you sell it, but you don't have to worry about recapture on land. But it will factor in to our netting process. Now guys, there's two different recap rules that we are going to concern ourselves with, okay? There's the recapture related to tangible personal property, which is code section 1245 recap. And then the book talks about 1250/291 recap. Okay, I'm going to tell you, do not worry about 1250 recapture. It is almost useless, that provision. Okay, it's really been replaced by 291. It's got a very, very narrow application. So do not worry about 1250 recapture. Do not confuse this with unrecaptured 1250. That is important. So I'm saying do not worry about 1250 recapture. We are very worried about unrecaptured 1250. Guys, I couldn't make this up if I tried, really.
They have that on CPA exam, the 1250.
Yes. Yes. 1250 probably not anymore. 291 probably. I know 1245, yes. Okay, guys. So, 1245. The idea here, guys, is look, you have this 1231 asset you're now selling, okay? 1245 and 291 properties are subsets of 1231. So all these assets start out as 1231 properties. But if you calculate a gain, okay, and if you take a depreciation, they may become also 1245 or 291 properties. We're going to focus just on 1245, which relates to tangible personal property, okay, used in a trade or business greater than 1 year. And to the extent you dispose of this property and you calculate a gain, okay, and it's created, that gain is either entirely or in part created by accumulated depreciation, that part of the gain becomes ordinary income. Guys, the book mentions that 1245 applies to intangibles. We're not going to worry about that. We're strictly going to focus on tangibles, okay? So, just some examples, and the book does this as well. I'm now disposing of, in 3 different scenarios, these are all tangible personal property. You can label them in your notes if you want. Okay? I have, in scenario A here, a tangible piece of personal property that I am disposing of. And I'm just giving you some basic information. I have the original basis, what it cost me when I bought it, the accumulated depreciation I've taken on it to date, and then ultimately what I sell it for. Guys, you could shorthand this, you don't have to go through all these steps, but look, the first step is saying, okay, I originally paid $500, I took $350 of accumulated depreciation, my adjusted basis at the time I sell it is $150, okay? I sell it for $200, minus that $150 adjusted basis, means I have a $50 initially 1231 gain, okay? It's a tangible piece of personal property I've used in my trade or business for greater than 1 year. I'm now going to sell it, okay? The initial calculation is our 1001 calculation. Amount realized minus adjusted basis equals our realized gain or loss. My initial realized gain here is 50, 1231. But I told you 1231 is only a temporary sort of holding period. We don't know yet. Now, since this is a piece of tangible personal property I've used in my business, I have to consider recapture, okay? The recapture rules say, look, to the extent this gain was generated by your taking depreciation, well, we have to take what was a 1231 gain and we're gonna recharacterize it as ordinary income right away. And the rule says that the lesser of the amount of the gain itself, 50, or the amount of the accumulated depreciation taken to date, the lesser of those two is the recharacterized amount. Here, 50 is the lesser of the two. It also is the entire amount of the gain. So instead of this being marked as a 1231 gain, it's all going to be marked as ordinary income right off the bat, okay? Slightly different scenario, different numbers. The original base is 500. I've taken less accumulated depreciation of only 250, sold it for 6. Okay, 500 original basis minus 250 accumulated depreciation means today the basis on my books is only worth 250. When I go to sell it, the $600 I get for it minus the 250 adjusted basis means I start out initially with a 350 1231 gain. That's my initial holding period for it. Okay, initially it all goes into 1231 gain. It's a tangible piece of personal property I've used in my trade or business for more than a year. If it was something I used in my trade or business, guys, for less than a year, it would be ordinary income, okay? It would not be a 1231 asset. But here we're assuming I held it for more than a year. Because it's tangible personal property, I've used it in my trade or business for more than a year, I have to consider recapture before I do anything else. Recapture says the lesser of the amount of the gain or the accumulated depreciation is recharacterized immediately to ordinary income, okay? So here, the lesser of those two is 250. So of my initial 350, 1231 gain, 250 is right away marked as ordinary income. The other 100 remains 1231 gain. We're still gonna need to figure out what to do with that remaining $100. We'll get there, okay? This is the initial step. Last scenario, I don't have to walk you guys through all this. Look, ultimately I sell it for $100. My adjusted basis was $150. So it results in a 1231 loss, okay? If it's a loss, recapture does not apply. Do not put recapture against a loss asset, okay? But it is important that is a 1231 loss because these losses, this gain here, are going to be fed into my netting process so we can figure out what to do with these 1231 gains and losses, okay? Recapture is an intermediary step. We still have more steps. Okay? You guys good with this so far? So you see a piece of tangible personal property, it's used in your business for more than a year, consider recapture. If it's used in your business less than a year, guys, it's not a 1231 asset, it's an ordinary income item or loss, okay? That's 1245. Again, 1245 relates to tangible personal property used in any form of business. So it could be tangible personal property used in a sole proprietorship, a partnership, an LLC, a corporation, what have you. 1245 applies to any business form, okay?
So when you have the, in part B, the $350 gain, and then you categorize it as a $250 ordinary income and then $100 1231 gain, or would you put 1245 gain?
I would put 1231 gain because we are still going to have to feed this into a further process. So leave it as 1231 gain. It's not going to end there. It will ultimately, like I said, end up as capital gain or ordinary, but we haven't gotten there. So no, leave it as 1231.
Are 1231 losses considered capital losses?
No, not yet. We don't know yet. They have to, after we do these individual steps for individual transactions, we have to take anything that remains 1231 and mesh them all together. That's when we'll figure out how to figure out if they're capital or ordinary. But again, we can't do that until we have all of our transactions for the year. Okay? Okay, guys, so this is 1245. 1250, I just said 1250 recapture, I'm going to tell you, do not worry about. It used to deal with, used to have to recapture accelerated depreciation. They used to allow you to depreciate real property on an accelerated method like tangible personal property, 200%, 150. You're not allowed to do that anymore, so a lot of the provision was sort of made defunct because now we have to depreciate all real property on a straight line. So the necessariness of that provision is sort of out the window. But 291 is important, guys, okay? 291, guys, applies to corporations only. Do not apply it to a sole proprietorship, an LLC, a partnership. 291 applies to the corporate format only, okay?
So don't apply to LLC and what else?
Only to corporations. Think of it, it's easier that way. No other business format. No LLC, no partnership, no sole proprietor, anything else. Only to corporations. And it's very, very similar to the workings of 1245, guys, except for it applies to the sales of real property. Okay, we're no longer dealing with tangible personal property. We're dealing with the sale of real property by a corporation. Okay? And here, we have a corporation who sells some real property they used in their trade or business for more than a year, okay? Same sort of workings here. work your way, figure out your adjusted basis unless it's given to you. We sell it for 500. My accumulated depreciation is 200. So I have a 300, 1231 temporary gain. Because this was the sale of real property by a corporation, I have to consider 291. 291 says 20%, okay? 20% of the lesser of the gain I calculate, or the accumulated depreciation I've taken to date, is converted to ordinary income immediately. Okay? It's a corporation, they're selling real property. 20% of the lesser of the amount of the gain or the accumulated depreciation I've taken against this asset to date are recharacterized into ordinary. So here, my gain is 300, my accumulated depreciation is 2, so 2 is the lesser, times 20% is 40. Okay? So 40 is recharacterized as ordinary. The other 260, guys, stays 1231 gain for now. For now, we'll still figure out what to do with it. Okay? So again, 1245 applies to tangible personal property to all forms of business. 291 applies to real property, corporations only, and it is reduced to 20% of the gain or 20% of the accumulated depreciation that gets recharacterized. Okay. One last one. This one is not considered recapture, okay? But it gets factored in the same as the recapture rules. Okay, guys, this is a related party rule. Code section 1239. Okay, code section 1239 deals with the sales of property between related parties. And the rule says that if one related party sells property to another related party and the property is depreciable in the hands of the purchaser, okay? It's depreciable in the hands of the purchaser. Then the entire amount of the gain recognized by the seller is ordinary. And again, guys, who are related parties? Family members, okay? A partner and is greater than 50% owned partnership, or a shareholder and is greater than 50% owned corporation. Okay, these are related parties. But again, guys, whenever you see related parties, know there's always a rule change. This one sells, if I sell you a depreciable asset, depreciable in your hands, the purchaser's hands, then I have to recognize all of that gain as ordinary, even if maybe I could have taken it as capital if I sold it to someone else down the street, okay? Then it becomes ordinary. I lose the benefit of that characterization. We're gonna do one right now.
The 50% that regards to yourself or to the purchaser?
If I'm a partner and I sell something to my greater than, I own more than 50% of the partnership that I sell the asset to, or I'm a shareholder, and I sell the asset to a corporation that I own more than 50% of, we're considered related parties. Okay. Any family member, if you're my brother and I sell you this asset, we're related parties.
Is this a problem with both?
No.
Oh, it's not. You
No.
just made it up.
No, so if you guys want to snap this with your phones when we're done, by all means. Okay, guys, so here's your example, Willis. So let's just say I'm a taxpayer, okay, and I'm going to sell, I don't know, a house that I own personally. Maybe it's my house that I owned and used personally. So really, to me, it's a capital asset, okay? And I sell it to my greater than 50% owned partnership, and they're going to use it as their new office building, okay? They're going to convert it. So it's going to be depreciable in their hands, and we're related parties because I own more than 50% of the partnership I'm selling it to. Same sort of calculation, guys, okay? I start out with, I bought it for 400, I ultimately sell it for 450. I won't have taken depreciation because I'm using this personally. When you use something personally, you don't get to take depreciation, right? So 400 minus 0 depreciation means it still has an adjusted basis of 400 when I sell it. The 450 sales price minus my 400 basis that I paid for it means I have a $50,000. Technically, it should have been a capital gain because it was a capital asset to me, right? If I sold it to Ron instead of selling it to my partnership, I would have had a $50,000 capital gain. I would have gotten the benefit of the 0, 15, or 20% tax rates. But because I sold it instead to my related party partnership, then it says no capital gain for you. All of your gain becomes ordinary income. Okay? Okay, guys. So those are the recapture rules plus 1239, which is not recapture, but which you should consider equally with the recapture rules. Okay. So what does all this mean? So here's our problems A, B, C, D, E, and let's just assume this is a sole proprietor or let's just actually assume this is a corporation, okay, that is transacted in all of these. They sold these three pieces of tangible personal property. They sold this real property. And let's just say it was a corporation here instead of a partnership, okay? These were their transactions. At the end of the year, the rules say you take all of their dispositions, okay, and you put them together. And this is basically, guys, the numbers from down below, these numbers here, okay? And you come up with their initial 1231 amounts, okay? Then the rules say you look at recapture. Figure out what amounts need to be recaptured of these amounts and instantly therefore become ordinary income. Then anything that's remaining, okay? This is where we're going now. So all of these transactions overall netted me a gain of 700. Instantly, going through this process, we recaptured 390 of this. So of this initial 1231 gain, we made 390 ordinary income off the bat. But we still have an overall 310, 1231 gain that we need to contend with, okay? And the rules say after you've recaptured and you take the remaining balances, look, there's a couple of gains and there's one loss, you net them together. If you have an overall net capital gain here, then this is treated as a capital gain, this is a capital gain, this is treated as a capital loss. If, let's just say I change this to 450, forget what's over there, the numbers, and this resulted in a $90,000 loss, okay? Then these would be ordinary forms of income, and this would be an ordinary loss. It comes down to, do I have a net capital gain, or do I have a net capital loss here? Right now, after going through my recapture process, and keep in mind, guys, these two have to add up to 700, okay? Again, your recapture doesn't change the amount of your gain or loss, it just recharacterizes. So we started off with $700,000 of 1231 gain. What do we do with this? First, we applied recapture. Recapture took 390,000 of the 700 and made it all into ordinary income. We still have $310,000 that we don't know what to do with. Okay, the netting process says if this is an overall net capital gain, okay, the gains are bigger than the losses, then everything is treated as capital. Capital gain, capital gain, capital loss. Okay, if instead the result was, let's just say it's minus 90, okay, I have an overall loss, then everything would be ordinary. Then I would end up with a net ordinary loss. That's not NOL. That's a net ordinary loss. Okay? This would be ordinary income, this would be ordinary income, and the 450 would be an ordinary loss that I can use to offset all forms of ordinary income. The best of both worlds. Here, I'm going to get a net capital gain. Good for me. I can use it to offset capital losses. Good for me if it's a loss, okay, rather than a capital loss, which isn't overly useful, I get an ordinary loss, okay? That's what the rules say. Good? Guys, stop me if you don't get it. Okay? You have individual transactions. As you're going through the individual transactions, apply the recapture rules, okay? Any balances that remain, 1231 gains, 1231 losses, like we had one here, okay? We had one here, we had one here, okay? These remaining gains or losses, after we apply the recapture rules, need to be netted together. The gains are bigger than the losses, everything is treated as capital. The losses are bigger than the gains, everything is treated as ordinary. Okay, it's all about character. We're not changing the amounts, we're just changing the flag of the character. It decides whether they're getting beneficial treatment or not. Okay, we're gonna keep going. There's more. After we do this netting process, okay, after we've applied recapture to the individual items, sorry, I can't stop. After we apply recapture to the individual items, we do the netting process, okay? If when you come here, you have an overall net capital gain, okay? Now we'll go through the netting process and you have a net capital gain. There's two more rules we need to consider. Okay, if you have a net capital loss when you get there, you don't have to worry about these rules. But if there's a net capital gain, there are two more rules to consider. Okay, the first one is our unrecaptured 1250. Unrecaptured 1250. Okay, guys. We talked about 291, where a corporation sells real property. Okay, that's a recapture rule. Now we have an individual, think sole proprietor. Okay, we have an individual selling real property they used in their trade or business. Okay, if you went through the netting process, there's a net capital gain, and you have an individual who sold real property, unrecaptured 1250 may apply. And guys, basically what this says is this doesn't recharacterize income from 1231 status to ordinary status. What this rule does is it says any gain as a result of depreciation, okay, is taxed at the maximum rate of 25%. So if you think back to the handout I gave you guys and we had that 25% rate and it said code section 1250 taxed at a maximum of 25%, this is where it comes from, is right here. Okay, you have individuals who sell real property. Again, think sole proprietor. They're selling real property. Unlike the recapture provisions where we said take the 1231 gain and convert it into ordinary income, this one is saying to the extent the gain they calculated is as a result of accumulated depreciation, then it's going to get taxed at a maximum rate. That portion of the gain gets taxed at a maximum rate of 25%. Let's see. I don't want to confuse you guys too much, but okay. So, building on the example. Let's say we have a sole proprietor, okay? Again, this wouldn't apply to a corporation because 291 would apply to a corporation. We have a sole proprietor, he sells a building he was using in his trade or business. Same sort of information, guys, okay? He calculates a 1231 gain on the sale of this building. Because again, it is a real piece of property used in his trade or business for more than 1 year. So it does start as a 1231 gain. The rule here says that unrecaptured 1250 applies to the lesser of, same thing, gain or the accumulated depreciation, which is the 200 of accumulated depreciation. So of this $300,000 gain, the sole proprietor recognized, 200,000 of it will be taxed at a maximum rate of 25%. The other $100,000 would need to still be tackled as part of the netting process. Okay? Well, there's a bigger problem which we can do. I can put this back. I'm going to change this for a minute. Okay, guys, here, this was a corporation we said a few minutes ago. I'm going to change this for a second to say this was all sold by a sole proprietor. So I want to change, I'm going to insert F where D is, okay? And I won't even change all these numbers. What I want to do is over here. 400, 340. So what I want to say is, now I'm assuming that this is a sole proprietor, okay? So this wouldn't rest of the information is the same. Let's just assume these assets were now sold by this person here. So he sold these pieces of tangible personal property, plus he sold this building, okay? So this is now his line. Recapture wouldn't apply because the real property was sold by an individual. This is not a recapture provision, so we would skip over that, okay? So all $300,000 would go into this category. And my overall capital gain would be $350, or $1230, I should sorry. My overall net $1231 gain would be $350. And again, because my gains are bigger than my losses, it says everything is treated as capital. Okay? Now is when I would go back in though and reconsider unrecaptured $1250. I'll put $1250. Okay? Now I would have to consider unrecaptured $1250. And the rule says, we just went through it, the lesser of the accumulated depreciation or the gain is taxed at a maximum of 25%. So of my $350 gain, guys, $200 will be taxed at maximum 25%. The other $150 is going to be my regular long-term capital gain, taxed at the 0, 15, or 20%. Say that again? Yes. It's the same, guys, it's kind of following the same format when we're looking at depreciation. It's always going to be the lesser of the amount of the gain calculated upon a disposition or the accumulated depreciation.
How come you didn't do it by the 200 then if that's the lesser of?
Well, I did, right? It's not a recapture provision, so you wouldn't put it in the recapture category. The entire amount of that gain is $1231 gain. This rule only applies after the netting process, okay? This rule doesn't apply before the netting process. Recapture applies before you put things into the netting column. This rule does not. This rule applies after. So you put the full amount of that gain into the netting, okay? And then it spits out an overall net capital gain.
So if the accumulated depreciation was 400,000, then the entire 400,000 would be taxed at the maximum of 25%.
If the accumulated depreciation was $400,000, I would have a $500,000 gain. So 500 would have gone here, and I would have taxed, yes, 400 at 25%, and then whatever the difference in the total column is would be taxed as 0, 15, or 20%. Yes. Guys, how many of you are kind of getting this and not getting this? This is important. Okay. The difference, I mean, guys, the rules overall are the same for calculating the individual amounts. It's just realize that with this particular rule, this unrecaptured 1250, you don't take these steps until after you go through the netting process. So you can calculate his total gain, okay? And that entire gain goes into the netting. You only figure out what to do. You look at these individual steps, you apply them now after you net. So his whole gain, we don't break it up into 200. I don't just say, oh, 200 goes into this because that's the smaller of the two numbers. No. Whatever the gain calculated on the disposition fully goes into this number. I only apply the rule after I come up with my total figure here. And again, the unrecaptured only applies if this is a net capital gain. If this worked out to be a net capital loss overall, even though maybe he had a gain when he sold that property, I wouldn't have to do this, okay? Unrecaptured 1250 wouldn't apply. Unrecaptured 1250 only applies when the total netting number is positive, okay? My total netting number is positive. Then I go back to my sale of the real property by my individual and I say, okay, of my total gain here, my total now net capital gain, the lesser of the amount of accumulated depreciation or the gain gets taxed at 25%. The rest remains regular long-term capital gain.
I'm only lost because then why do we look at if 1231, the remaining is
if the gains are less than or greater than the losses. So if the gains are larger, then everything becomes ordinary, so why would,
If the losses are larger, everything becomes ordinary.
yeah, so then why do we break it down to like capital gains, the unrecaptured, everything's becoming, I don't know, the whole thing about like the gains are less and losses are like, or greater than.
Well, at the end of this, because look, I mean, as of right now, this is your remaining 1231, okay? These are all your balances that are still 1231 balances. And the idea is that things can't stay 1231, they have to get designated as capital or they have to get designated as ordinary. And the rule says you take any of these balances, if it's a positive balance when you add these things all together, everything is treated as capital. It's all gets capital asset treatment. If this is a negative overall, then these are all ordinary income and they just get taxed at ordinary rates. So I'm not sure.
So after that, how come we're splitting it up? Like you have like long-term capital gain.
Well, these are, keep in mind, this is still a long-term capital gain. It's just not getting the 0, 15, or 20 rates, right? Those 28% rates, those 25% rates, they're still long-term capital gains, guys. It's just that they don't get that 0, 15, 20 rate. They get different rates. They get 25 or 28 rates.
Yeah, okay, got it.
But they're still long-term capital gains. So yes, this is all still long-term capital, just different rates.
Yeah, okay, got it now.
Okay, so when you're originally doing the netting process and you have real property for an individual, so none of that is ever going to be ordinary income. For like
It could,
So
it
when
could, if, let's just say this was a gain, he sold this property at a gain, but let's just say this was a huge loss. Let's just say this was like $1 million loss. So my overall number here worked out to be like minus 500,000, my net number. Then all these items would become ordinary income or ordinary losses. And in that case, we wouldn't even bother applying this unrecaptured rule.
when we're doing like that part though, like figuring out like the 1231 gain, wouldn't originally we would choose the 200 would be ordinary income and then the other 100 would be the 1231
The
gain?
unrecaptured 1250, which is what we're doing here, again, that doesn't convert anything from 1231 to ordinary. It's not a conversion rule, it's a taxing rule.
So if you have real property that an individual is selling, when you're netting it, it's always going to be under the 1231 gain. You're never going to put any of it under the.
It's not recapture,
Okay.
it's unrecaptured. So it's no, so in that particular case, it'll never, none of it will ever be marked in this column. It'll all initially go into this category. Then we look to see, when we add it with our other transactions, is the overall positive? If it is, then you go ahead and you take your second steps and say, okay, well, how much of this is taxed at 25%? How much is taxed at the regular 0, 15, 20? If this works out to be an overall loss, then everything up above is ordinary income, ordinary loss, and you don't have to apply this rule. Okay?
I'm still not sure when you're doing the lending process and you have a negative, when is it ordinary loss, when is it capital loss?
It depends on what you work out here. So again, if you take the sum of whatever, however many things are added together here, does the net amount work out to be positive? If the net amount is positive, then everything up above is capital gain, capital loss. If the total works out to be negative, then everything up above is ordinary income, ordinary loss, no special rules in effect. And again, if this is an ordinary loss, we don't have to worry about this unrecaptured rule. Okay, we're still going to factor in whatever amount he sold his property for in this column, but that's just going to be part of figuring out, do we have a net capital gain or do we have an overall loss? But if this is, I mean, don't worry about the numbers themselves. Is it positive or is it negative? If it's positive, then everything's capital. If it's negative, everything's ordinary.
No, I think she means like at the bottom, like I think, you know, because like if you add everything up, like see the 50,
Yeah.
like that's a capital loss.
Yeah.
You know, that's what I'm saying. I think she's looking to label underneath the line if it's capital gain or loss right there. You know what I'm saying? She, like I think it's. I understand what she's saying. It's kind of confusing.
I mean, it's just, it's not. If it's positive, then this is a capital gain.
Yep,
This
that's
is a
what it
capital
was.
loss. This is a capital gain. If it's negative, guys, then this is ordinary income. This is an ordinary loss. This is ordinary income. Again, if it's positive, everything up above is capital. If it's loss, everything is ordinary.
Now, Professor, on a test, like with a question like that, would you switch and say, like, you know, with the corporations where you can carry back and carry forward, are you gonna do that in a question? Like, you know, are we gonna take that, you know, when we can,
I'm not gonna ask you to calculate taxes, guys, like we've been there, done that, but I could ask you, well, how much of this is taxed at 25%? How much of this is taxed at the regular 0, 15, 20%? That's as far as I would take it. I wouldn't ask you guys to go back in and calculate, go back through all those old rules.
yeah, like take $3,000 if you're an individual or if you're a corporation.
You
carry-
should know it, but again,
but-
I'm not gonna ask you guys to calculate taxes.
Okay.
I'm gonna ask you, I would ask you how
We're
much
just
of
doing
this
the
is
tax
taxed
part.
at
Okay.
what rates, but I'm not gonna ask you to actually calculate the tax. Guys, are we good? Go ahead.
Alright, as far as the losses go, it should, you label it as a capital loss, that's just for the netting purpose, because the way the book made it seem, it made it look like, it was like the loss, it said if it's a loss, it's an ordinary loss, so it made it look like you automatically take it to.
If it's a loss, it's an overall, look, overall, if it's a loss, overall, yes, it's an ordinary loss, overall. But individually, those items will be ordinary income and ordinary losses. When you net them all together,
So you're not gonna take it individually, the ordinary loss, and then apply it to the income.
no, because different transactions are different transactions. I mean, technically, each item is its own stuff. That won't screw you up. Just, if it's, again, if the number overall is a loss, everything is ordinary. If the number is overall positive, everything is capital. The problem with capital comes into, okay, then if it's positive, we have extra rules to consider. This is one of the extra rules. Again, if it's capital, guys, you know, we have potentially special rates involved. This is one of the special rates. So this is not a recapture provision. So now, as Samantha was saying, this will never end up in the recapture category because this is unrecaptured 1250. It is not recapture. This is a taxing provision. This does not change the character of anything. This simply is dictating at what rates the amount of gain will be taxed at. Again, presuming that the overall netting process results in a gain. The overall netting process results in a loss. We don't have to worry about this provision. It doesn't exist. Everything will just be taxed as a capital loss. Okay? Okay. All right, guys. 12:31. All right, there's one more. We should be able to get through this. Now, so I said if you get here after your netting process, okay, and you have an overall positive result, okay, this is one rule we have to consider, is the unrecaptured 1250. The second rule we have to consider, guys, is what's called the look-back rule, okay? So if you do your netting process, after you apply your recapture provisions and your 1239, and you come up with a gain, an overall gain, first considered unrecaptured 1250, okay? That applies again to the sale of real property by individuals, and it's a taxing provision. Then we have to look to the look-back rule. And what this rule says is that if we calculate a net gain in the current year, you have to look back to the prior 5 years, so 5 years before the current year. And you have to look for any unrecaptured losses, okay?
Does it include that current year?
No, 5 years before the year. So this would be like the 6th year. And this rule will in fact basically take what is reported currently as an overall gain, okay, which should, if it's an overall gain, get capital asset treatment. But if you have these unrecaptured losses in prior years, it'll take the current year gain, and here it will recharacterize the income to ordinary to the extent these losses exist in prior years. We'll walk through a problem. The reason, guys, this rule exists is because taxpayers here can kind of manipulate the timing of their gains and losses if they're careful. okay? You could have taxpayers who could carefully say, I'm gonna sell all of my loss assets this year, okay? And I'm gonna get myself a nice ordinary loss. I'm gonna use that ordinary loss to offset all forms of ordinary income. Then in the next year, I'm gonna sell all of my gain properties, and I'm gonna get myself a capital gain. I've got the best of both. I got ordinary losses in this year, I got capital gains in this year. And what are they doing? They're pulling forward their deductions. Congress doesn't like that. They're pushing back their income to the second year. We don't like that. And they're manipulating the timing. We definitely don't like that. Okay, so that's why they bring in this 5-year look back rule. And we'll just do a problem because it's the easiest way to walk through this. Let's look at number 53. We have Morgan's Water World, an LLC opened several years ago and reports the following net 1231 gains and losses since it began business. What amount, if any, of the year 7 $113,000 net 1231 gain is treated as ordinary? So this is problem 53. Okay, guys. And this is what, after they sold different assets throughout the years, these are the net amounts that they would have recorded, either positive or negative during the year. And they want to know in year 7 how much of this would actually be recharacterized, because again, the look back rule is a recharacterization rule. This should, since we calculated an overall net positive number, you would say, oh, get capital asset treatment, but for this look back rule. Okay, if there's unrecaptured losses in prior years, we're going to take some of this current year, what should be a capital gain, and turn it into ordinary income. Okay, now in year 11, they reported a loss. Okay, in any year you have a net loss. Again, unrecaptured 1250 wouldn't apply. Look back won't apply. So in year 1, guys, they're going to report the $11,000 the way it is. So I'll put report. Okay, so in this year, they would have reported $11,000, and it would have been an ordinary loss. Okay? Year 2 comes along, and they come up with a net capital gain this year. They would have had a positive $5,000, which should become capital gain.
You wouldn't, even if your loan was positive, you wouldn't consider it anyways, right? Because it's not within the 5 years.
I would have to go back to the earlier 5 years. This is like the beginning of the business, so there's nothing to go back to.
No, I'm saying in year 7, you're in year 7.
Oh no, but yeah, I have to work my way up. I have to work my way down because they haven't done this process. They're assuming that how would they have reported? They're just saying, look, these were the net amounts for each of these
So they
years.
have to look back.
I know what you're saying.
Got it.
They've never done this already, so we have to go back and do it for them.
Okay.
So year 2 comes along, guys, and they went through their netting process and they come up with a positive. Now this look back rule says, wait a minute, to the extent they reported these losses in prior years and never recharacterized using those losses, you have to now recapture them. So there's $11,000 of losses from the prior year, okay? We should report this as a capital gain, but the look back rule says, wait, they had losses of $11,000 in the prior year that they didn't use. And they don't want us timing, right? This is exactly what they don't want us doing. They don't want us accelerating our losses and deferring our gains. So they say, no, you would have gotten a capital gain on this, but you had a loss the other year, so you now have to recapture this. So instead of taking this as a capital gain, you have to now report that $5,000 as ordinary income, okay? And I have now used up $5,000. I recaptured 5 of that 11, and I still have 6,000 out there that I haven't used yet. That's available for more recapture down the road. Okay? I have to use prior year's numbers. So there was 11 there. I'm going to look in. I'm going to use 11 of last year's. So I'm going to convert all 5 to ordinary income instead of reporting it as capital gain. I've now used up 5 for recapture. There's still 6 available for me. comes along, it's a loss, okay? This rule doesn't apply in a loss year, so nothing to be done. They're gonna report all 21 as ordinary loss. Same thing here, doesn't apply in a loss year, it's all gonna be ordinary loss. Year 5 comes along, okay? We have an overall positive. And we have some unrecaptured gains, or I should say losses, that we haven't used. So we want to report this as a capital gain, but the look back rule says you have to look back 5 years for unrecaptured losses. So I have to go back 1, 2, 3, 4, well, there's only 4 years, so that's as far as I can go. I didn't use this 6. So I'm now gonna use up this 6 and convert 6 of this into ordinary. There's nothing to use there. I have a whole bunch that I can use here. So I'm gonna use 11 from this, okay? So I'm gonna use up this 6. This is now all used. And I'm gonna use 11 from this. So that's gonna get me my 17. So all of that, what should have been capital gain, is now in fact ordinary income, okay? I used up 11 of this, I still have 10 available for me. It's a loss year, nothing to be done. Gonna report it all as ordinary loss. Big year, got 113, okay? And again, I have to look back. I can go back 5 years. 1, 2, 3, 4, 5, okay? Nothing, well, I can't use that year even if I wanted to, plus it's all used up anyway. It's a gain year, nothing to be used, okay? I've got 10 there I can use. I can use 4 here. There's nothing available here. And I've got 43 here, which is unused. Okay, so that's 57 is going to be reported as ordinary income. The other 56 will be capital gain. Okay, again, the idea here is that they don't want people timing and manipulating the rules to their advantage. They don't want them putting all losses in 1 year, pulling them forward, deferring gains. So this look quick rule, for anyone who is trying to time, kind of makes the point moot. It's saying, you know, you would have had a capital gain, but because you reported all these losses in 1 year, we're going to recharacterize anyway, and we're going to make it into ordinary income.